to The Pulse.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in for Francine this Monday morning out of the European headquarters, of course, here in London. A redhead crossing the terminal. Again, this ties into the data that we're getting out across Europe. The German yield curve disinverting for the first time since November 20... Let's get the full year. It's 2022. So the German yield curve disinverting for the first time since November 2022. I talked about the fact that the front end of the German curve was being bid on the back of this pretty grim data across the Eurozone, most pronounced in terms of the services move, in fact, in France. But the yields are bid. German debt is bid. Yields down 7 basis points. Bonds are bid. Yields down 7 basis points at the front end. That's the German 2-year at 2.16. The 10-year at 2.16.3, so essentially flat from 2s to 10s, yields down 4 basis points at the long end. That's the redhead. The yield curve disinverting for the first time since 2022 of November of that year. Let's bring in right now for a check and a view on what we've been seeing out of Europe then. Marija Veitmane, Senior Multi-Asset Strategist at Straight Street. Marija, my first question to you then, are markets underestimating how far the European Central Bank will have to go to shore up what is now looking like an increasingly beleaguered European economy?
Yeah, good morning. I have to agree with you, Tom. For a long time, we were worried about the state of European economy. I mean, Germany is kind of quite central there. And the story for a long time has been that, okay, manufacturing is really struggling. We see slowdown in European domestic activity. We see slowdown in China, which is kind of important business partner for a lot of European companies. Manufacturing was struggling. Services were fine. And ECB was kind of bidding it time in terms of rate cuts, but the longer we waited, and we got kind of a snowball effect, is that manufacturing struggle. Now we have problems in service sectors. So indeed, market is almost kind of demanding, demanding for more aggressive rate cut, especially after what we've seen Fed has done. Fed is trying to get ahead of the curve and cut more aggressively than maybe U.S. economy absolutely needs at the moment. ECB is definitely behind the curve and kind of needs to do more.
ECB is behind the curve. It needs to do no more. Markets pricing in around 43 basis points of additional cuts by the end of this year. So that has moved in the last few hours, increasing the expectation around the number of cuts, getting close to 2 additional cuts being priced in by these markets by the end of the year. Marija, are we looking at 2 very different scenarios now? Is this being crystallised for us, that this is a European Central Bank cutting into a recession, potentially, versus a Federal Reserve cutting into a soft landing?
Yeah, no, absolutely. And I have to say that, I mean, you know me long enough. I've been a big fan of U.S. stocks over European stocks, and that's been really the part of the story. U.S., first of all, is far more service-oriented in this economy, more domestic economy, so it has a lot more strengths to start with. European is manufacturing, export-oriented, and already had a lot of weakness. And you absolutely correctly kind of mentioned that Fed is almost kind of providing a food, saying that, okay, economy is still robust enough, but we're going to cut because labor market is slowing. And I think it's an important point. It's not slow yet. It's slowing. While in Europe, we already see a lot of trouble, and ECB is yet to kind of provide material support.
So, Marija, let me ask you then, if the ECB does step up its support and come through with more cuts than maybe the markets are now pricing, is that enough for you? Would that draw your interest? You have that. You've just illustrated and underscored your preference for U.S. equity markets at this point. Would a more aggressive rate cutting cycle from the ECB lead you to want to increase your exposure to the Eurozone?
I think like more aggressive rate cutting, of course, it would help. I worry it could be, the case of too little, too late, because like what you mentioned, Tom, is that ECB will be cutting into recession. And historically, that's kind of what typically happens after central banks start cutting. It's almost kind of admission that we have a big problem. Fed is trying to do something very, very different right now. They're cutting while there is still residual strength in the economy. So I think that's kind of fundamental difference. And I think it will take quite a lot from ECB to change my preference for US stocks over Europe.
Maria, if we're looking for silver linings and green shoots, could that be provided by China? They're cutting rates. There is going to be a briefing tomorrow, very unusual, from top regulators. Should we start to be at least thinking about a China and a policy apparatus that comes through with more significant support that could ripple across to Europe?
I think that's been a really, really big hope from investors in terms of China, because we know that particularly Chinese stocks, Chinese bonds, they're very, very cheap, right? So they trading at a big discount for obvious reason. We know that investors in a large part stepped away from this market. So every time there is a hope for policy support, there is a kind of expectations. People obviously kind of pay a lot of attention, given that kind of the delta on that move could be potentially very, very significant. So far, all the announcements of kind of policy support have been very marginal, very incremental. So officials were still kind of shying away from tackling, like in a big way, the property sector and supporting it. So that has not happened. We're always very careful watching it, but unless we see like a massive announcement of really going to the core of kind of underlying profitability, substantially increasing lending, substantially increasing like consumer spending, property reform, unless we see that, we'll be quite skeptical.
Marija, back to the US then, which you favour, of course, as a region. And you've been consistent on that, and presumably it's paid off, given the outperformance still of US markets. But you're not convinced about the rotation trade from mega cap tech into small caps. What would convince you that rotation is a play? Why the scepticism around the rotation trade, given that we are now in this rate-cutting environment?
Yeah, no, Tom, very grateful for you remembering my positive view on US consistently. And the reason I liked US was pretty much always because I really, really like US tech sector. To me, US tech sector is about innovation, about earnings growth, but this time it's also about very, very strong balance sheet, very good quality characteristics where you see strong balance sheet, strong earnings growth, strong cash flow generation. So that's really the core of kind of our preference for tech. Small caps, they look interesting, and those companies definitely will be supported by lower interest rates because they're very interest rate sensitive. The thing I worry about small caps is that they're very economically sensitive as well. And what we know already is almost a quarter of companies in Russell 2000 or S&P small caps, they are loss-making. So, okay, yes, you get a boost from lower interest rate, but you still need to see those profits, and that's not what we're seeing right now. And I think now, when the economy is slowing, you need to see quality, you need to see better companies, and that's not small caps.
OK, Marija Veitmane, Senior Multi-Asset Strategist at State Street, still making the case for big tech stateside in terms of where you want to be putting your preference in this environment. Marija, always appreciate the context and analysis. Thank you very much. Let's check in on some of the key movers and some of the standout stock movers in the session today. Commerzbank in focus on the news that the German government is halting and has halted additional share sales, of course, after UniCredit built up that significant stake of a little over 9%. And we've seen the ramifications of that politically, domestically in Germany. Commerzbank down 5.2% then on the back of that news. That is a story we will keep across for you. LVMH, amongst other luxury names, Hugo Boss is also in the mix, being downgraded by Bank of America on the prospects for luxury, down 1.1% then for LVMH. And Rightmove, a really fascinating potential takeover story. Rightmove up 2.7% as the company responds, saying it is going to consider, and it will consider, the board will consider a third increased offer from Regroup in Australia, of course, Rupert Murdoch's business Regroup. So Rightmove saying they will consider that third upped proposal from that company. Coming up, we are going to head to Berlin as Chancellor Olaf Scholz's party narrowly avoids defeat to the far right in state elections. More on that next. This is Bloomberg. Welcome back. Well, it was a busy weekend for European politics, with migration a key theme in state elections in Germany. In France, meanwhile, the new government is already facing opposition. We're going to speak to our Paris bureau chief, Alan Katz, in just a moment. But first, we're going to cross over to Berlin, where Bloomberg's Oliver Crook is standing by with the take from the state elections and the importance of what it means, of course, for Olaf Scholz. Where does this leave the Chancellor? What did we see in these state elections? How does that leave the German body politic at this point, Ollie?
Yeah, Tom, so listen, this falls short of the worst-case scenario for Olaf Scholz, which was if the AfD would to win the #1 spot in Brandenburg. And the reason that Brandenburg is so significant, it is the region that is around Berlin. But more importantly, Tom, this is a region that has been dominated in terms of the political power by the Social Democrats since the reunification of the country in 1990. They've literally never lost an election in that region. So the fact that now they have won, yes, is encouraging for the government and the coalition and for Scholz himself. But they won by just under 2 points, which is hardly a sort of rousing endorsement for Scholz and the government there. It's also where Scholz's sort of home constituency is in Potsdam. I think what it sort of illustrates when you look at the scores up there on the board is that it's going to be very difficult, and this is something that we're going to see across Germany, to really build coalitions and really govern this country at a time when, as we've seen even today with the PMI data, there is all this sort of economic trouble going on in Germany and going forward. And it's really highlighted with, Tom, as you mentioned, that issue on immigration, where on the one hand, there's a lot of sense that they don't want any more immigrants, and this is why the far right and left is doing very well, while at the same time, Scholz acutely aware of the fact that there are just not enough people in this economy to get it going, and that is the political difficult line that they're walking now in Germany.
That's a really interesting central tension point, isn't it, between the immigration concerns and the challenges, the shortages within the labour market of Germany. Ollie Crook, thank you very much indeed in Berlin, interpreting the state results for us. At this point, let's turn to France and the new cabinet that, of course, has been appointed over the weekend. Our Paris bureau chief, Alan Katz, joins us now for what's happening in terms of French politics and whether or not, indeed, this new government can even stand the test of time. Alan, what is your key takeaway from the names in the list? The cabinet of France has been appointed, but how sustainable is it?
Well, that's a good question about how sustainable it will really be. I mean, one of the things that was really striking about this cabinet is that there are really very few sort of brand name politicians that are in it. And that just goes to show sort of how leery some people are about joining this, what could potentially be quite a short-lived government. I mean, I guess sort of one of the key takeaways from it is that sort of socially and on immigration, an issue that Ollie brought up in the German election too, on immigration, it is moving toward the right. And Michel Barnier, the prime minister, was on TV last night, and he made that point that they were going to be a little less positive on migration than the prior administration had been. Bruno Retailleau, who's on the screen right now, is the new interior minister, and he's traditionally been relatively on the right on that topic. The funny thing about it is that in terms of fiscal policy, they're sort of moving to the left. Barnier, again, last night, didn't rule out taxing the rich and big companies in order to try to reduce France's debt in order to maintain credibility on debt markets, because France has such a large national debt. And that's sort of it's been a real taboo under Macron, who's really tried to make sure that they don't raise taxes, particularly on business or on wealthy individuals, in order to try to attract people, to try to grow the economy enough in order to be able to reduce its debt. That hasn't worked out quite that way for Macron, and now you have sort of this move, surprisingly from a conservative politician, a bit to the left on taxation. Now, that said, on the question of how long does this government last, those policies both move right on immigration and left on taxation of the wealthy and big companies, sort of aligns with the far-right National Rally. Now, it's not as extreme as their positions are, but it does sort of go in that direction. So that might indicate that the National Rally would be inclined to abstain from a no-confidence vote, which could happen as soon as next week. And maybe this government would last a little bit longer. But again, we'd have to see when it actually happens.
OK, Alan Katz, Bloomberg's Paris bureau chief, on the political contortions needed by the new Prime Minister and his government. Alan, thank you very much indeed. Coming up, Israel calls for civilians to evacuate southern Lebanon as it steps up those attacks against Hezbollah targets. We have the latest on the situation in the Middle East. This is Bloomberg. Welcome back. Israel is stepping up its attacks against Hezbollah targets in southern Lebanon, urging civilians to move out of the area. Bloomberg's EMEA News Director Ros Matheson is here with the latest. There's been a lot of news out of the region over the weekend. It certainly feels, and there's a sense, that the two sides, Israel and Hezbollah, are moving closer to full-blown war.
Well, that's the big if, and what does that look like if it does happen? I mean, they're pretty much exchanging constant fire across the border. We have Israel saying it wants to move its residents back to the north of Israel into potentially harm's way, and it wants people in the south of Lebanon to move out of the way, because what they really want to do is push Hezbollah back. They want to push them back from the border. That means degrading Hezbollah in those areas, degrading all the infrastructure they've set up there, targeting their missile sites and so on, because of course, Hezbollah, has a lot of missiles and a lot more manpower than Hamas arguably does. And so they're a much bigger threat potentially to Israel in the longer term. So getting them back from the border is really important. But at some point to do that, do you have to send Israeli troops over the border into Lebanon? And that's really a ground war at that point, a full-blown war. And that's what everyone is worried might start to happen, is inevitably, are you going in that direction? But right now what we're seeing is a really stepped-up level of attacks by both sides, also from Hezbollah across the way, obviously in the aftermath of those, pager and device explosions that we saw, and then the airstrike to take out yet another Hezbollah senior figure last week.
So that's Israel and Hezbollah, and you mentioned and you touched on Hamas as well, and reports, at least the IDF, suggesting that potentially, has not been confirmed yet, that the leader of Hamas, Yahya Sinwar, may have been either hit or even killed in a strike in Gaza.
Well, that's right. This is coming out of the fact that even though Sinwar is in hiding and obviously not directly engaging, is that some people normally do hear from him every few days, because in the aftermath of the assassination of Ismail Haniyeh in Tehran a bit over a month ago, he's now also the political chief, which means he's really the go-to person in these truce talks that have been ongoing, even though he's not there in person. And so having him involved in messaging is important, but there's been no sign of him. The question is he just in hiding or is he hurt?
OK, Ros Matheson, thank you very much indeed on the latest on that fast-evolving situation, of course, in the Middle East. Coming up, can the UK's Labour Party reclaim their change narrative after a series of missteps? We're live on the ground at the party conference in Liverpool. That is next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. The euro falls and traders increase bets of ECB rate cuts. That's as business activity in the euro area saw a surprise contraction in September. Scholz dodges defeat. The German Chancellor's party scrapes a win in his home state of Brandenburg, narrowly holding off a surge in support for the far right. Plus, Intel rises pre-market, with Apollo said to have offered a multi-billion-dollar investment in the struggling chipmaker. Meanwhile, rival Qualcomm apparently explores a takeover of Intel. Let's check in on these markets with a focus on the data out of the Eurozone. The manufacturing print out of Germany for the month of September coming in at the weakest in over a year. Euro taking a hit at 110, down 0.6%. German bonds are bid. You've had the curve disinverting, 214 on the 2-year, yields down 8 basis points. A pronounced move into German debt on expectations the ECB will have to do more to support this economy. Services out of France for the month of September as well. The weakest print since March of this year, tumbling into contraction. Brent crude at 74.50. We keep an eye, of course, on the conflict between Israel and Hezbollah. In terms of what is happening with the spread and the premium on French assets over their German counterparts, there is a redhead that crossed the terminal right now. You can see the chart, of course. The 10-year yield on French sovereign debt oats over their German counterparts, rising the most since August. Two reasons for this, I would surmise, is number one, the potential fragility of this new French government and threats, of course, to that government in terms of no confidence votes that could happen as soon as next week, and what we're seeing in terms of the bid for German debt. So yields down on German debt, and you're seeing then that spread between French and German debt just widening, so around 80 basis points. A reminder, again, of the challenges, the fiscal challenges of this new French government. In terms of the data crossing out of the UK, we're focused, of course, on the PMI prints out of the UK. September manufacturing PMI falling to 51.5. This is a miss versus the estimates. You can see the pound down 0.5%. The survey had been for UK manufacturing for the month of September to come in at 52.2. In fact, it's fallen to 51.5. Still just about, of course, in expansionary territory above that 50 line, but not by very much. In terms of services, that part of the mix as well, services for the month of September, PMIs coming in also below the surveys here in the UK, 52.8, below the 53.5 that had been expected by economists. So a weaker set of data out of the UK as well, even as those two numbers remain in expansionary territory. But again, the challenge is also around a cooling UK economy, which, of course, is part of the debate and part of the questions facing UK Chancellor Rachel Reeves, who's been speaking to the British media, pledging that the government will not bring in a wealth tax, and that there will be growth in public spending. Reeves is due to address the Labour Party conference later today. Let's cross over to Bloomberg's UK correspondent, Lizzie Burden, on the ground for us in Liverpool. Lizzie, so it's business day today in Liverpool at the party conference. What is the mood on the ground given the missteps of this government in recent days?
Well, Tom, it's getting busier here in the conference hall. I'd say the mood is upbeat but apprehensive. The headlines over the weekend have been dominated by stories about infighting at number 10 Downing Street, freebies from donors and gifts and what access and influence they buy. But look, today, Keir Starmer and Rachel Reeves want to hit the reset button. The slogan of the conference is change begins. As you say, we're going to hear from the Chancellor herself later on today. We're expecting her to deliver a more positive message on the economy, to say that it's not going to be an austerity budget on October the 30th, because, of course, we've had this doom and gloom narrative on the economy throughout the summer. Maybe those figures that you just reported justify that narrative a little, but we have had a bit more confidence from the Bank of England Governor Andrew Bailey, for example, on Thursday, justifying why the BOE didn't cut by 50 basis points like the Federal Reserve. The problem is you've got wealth creator after wealth creator in the UK telling us and others that they're looking to potentially leave the UK if there are tax rises in that budget on October the 30th. So it'd be interesting to hear what she says later. I just asked one business leader whether the mood today was different from a year ago among the business community. He told me that it's not jubilant, the mood is do not screw it up.
OK, Lizzie Burden at the UK Labour Party conference with a warning there, at least from one member of the business community for this new Labour government. Lizzie, thank you very much indeed. Now, let's switch focus to the world of emerging markets. Equities in China beginning the week on a positive note. Not every day we get to say that. After the PBOC pushed the button to release more stimulus with a cut to one of its short-term policy rates, officials will issue a rare briefing on the economy tomorrow. That could be consequential as well. For more on the markets with a focus on EM, we are joined by Phoenix Kalen, Head of Emerging Market Research at SocGen. Phoenix, great to have you in the studio. Is it right to paint a picture where EM now, the stars are aligning for emerging markets? You have a more proactive policy front from Beijing. Some would say finally, belatedly, and we'll see what the details are tomorrow. At a time, of course, when the Fed is cutting rates. Are the stars aligning for EM, and if so, where do you want to be leaning?
Yeah, it's such a rare moment to have emerging markets come under the spotlight in a positive way. You know, we've had so much concerns around geopolitics, around growth, around inflation, and commodity prices have been volatile as well. So it's now the moment where we see much more inflection toward a positive paradigm shift for emerging markets. We see the carry monster from the U.S. is much lower. We're seeing kind of much more stimulus measures coming out of China. Of course, they will have to do much more over the coming months to kind of stem the confidence crisis. But that's starting to happen. And then the inflation genie is back into the bottle. We think commodity prices are set to go much lower over the course of the next year. So that's quite beneficial for the inflation outlook as well. And growth is not great. It's still relatively stagnant and decelerating in major parts of the world's economies. But that's actually quite positive news for the rates front. So people can pile back into the fixed income side much more aggressively now, as they have been over the past 2 months.
OK, so there's a number of catalysts that you've outlined for us, and you would say pile back into fixed income. Whereabouts would that take you? You're talking sovereign debt, and which parts of the EM space is looking most attractive then on fixed income?
So the carry component is still quite strong in LATAM, and we are seeing some people pile back into there. I think that momentum is going to accelerate, especially after the U.S. November elections. There is still a lot of growth that's geared to the U.S. economy. We'll see how that plays out, but I think in the short term, there is so much concerns around what happens with the U.S. elections in terms of implications for LATAM assets that investors are a little bit sidelined and waiting for that event risk to be over before coming back in. So I think LATAM is one area that's looking very attractive. Some parts of CEMEA as well, South Africa, Turkey, Czech Republic, those are all looking really strong on the fixed income side. And then, I think Asia as well is an area of appeal now that we've got much more confidence in terms of the China policymakers coming out with more aggressive support and more rate cuts down the pipeline.
So which asset classes are best positioned should Beijing come through with more forceful stimulus that actually has an impact, particularly on the consumer of China? Which part of the story within EM is best positioned to get the upside from a more hands-on approach from policymakers, if that's what we get?
So I think the rate story is much more appealing at this timing of the cycle. The currency side, we think, is going to be relatively stable. We're not going to see massive devaluation from here. We're thinking that the exchange rate is probably going to stay stable between kind of 7.05 to 7.2 against the dollar over the course of the next year. But the fixed income side, there we're likely to see much more aggressive rate cuts, much lower mortgage rates, possibly more stimulus measures for consumption as well, as they pivot toward kind of more proactive easing. And so I think the fixed income side really presents attractive prospects for people to pile back in.
What is your level of comfort in taking a bet that softer US dollar will be sustained in this environment?
I think it's a multi-pronged picture whereby, it's about the collapse of the U.S. exceptionalism story. It's about people able to do much more hedging as U.S. rates come down, especially in the front end. It's about kind of the monetary policy divergence versus other global central banks. All of those factors are happening alongside that carry unwind that has been the position for so many years. So I think all of that is going to detract from the appeal of U.S. assets, and those flows are going to naturally go back into some of the more risk-sensitive segments like emerging markets.
Because the call around the end of US exceptionalism, that's been made before and it's been premature. But you're pretty convinced that this is the end of US exceptionalism is what we're now looking at.
We are seeing the U.S. economy slow down significantly across various broad-based sectors. We are forecasting for the dollar to be on kind of a secular multi-year trend of decline, going back toward kind of, euro dollar back to 116 middle of next year. Versus the yen, we're expecting for that exchange rate to go down toward like 127 by middle of next year.
127.
So yeah, okay. Aggressive moves.
Before I let you go, just a quick one on oil. Oil down, Brent down around 3.5% year to date. Are markets underestimating the disinflationary impacts of oil?
Yes, I think, SG has been pretty aggressive in forecasting how the oil price trajectory is going to come down significantly because of the resilient non-OPEC supply picture, because of how demand is collapsing across various sectors in the global economy, because, of course, there's expectations for the OPEC Plus to release more barrels come December. So I think all of those components are going to weigh on oil prices. We're expecting for them to average around $66 per barrel next year, coming down towards 62 by the end of next year. So it's a downward path, very downbeat on oil prices, and that's going to support kind of the consumption side of emerging markets in particular.
Okay, Brent currently at 74.37 with call that maybe gets to 62 by next year. Phoenix Kalen, thank you very much indeed. On this moment for emerging markets with a particular focus on fixed income. Phoenix Kalen, head of emerging market research at Societe. Coming up, France's new government faces opposition already. We will be looking at whether Michel Barnier's top team, well, they can actually survive. Stay with us. This is Bloomberg. Welcome back. Now, France's new Prime Minister, Michel Barnier, named his cabinet late on Saturday. But an angry reaction, both the left, mostly from the left, and the right as well, means his government is already at risk of collapsing. With me now for the details of the analysis is Marta, Lorimer, a politics lecturer at Cardiff University with a particular focus on the politics of France. Great to have you in the studio to give us this context, because the question, I think, for the markets is how sustainable this government of France is actually going to be, to what extent there is a threat now from the left and the right to push through a vote no confidence. Can this government survive?
Well, the good news for the markets and for France for now is that Macron cannot call an election until next year. So this does mean that we are looking towards some stability, at least in the short term. There are going to be votes of no confidence. The left has already said that the first thing that they will do once the government is introduced to the parliament is going to be calling a vote of no confidence. But it is very unlikely that the National Rally will vote against the government in that vote specifically.
And is that because Rassemblement National, or National Rally of the party of Marine Le Pen, is that because they align politically to a lesser or greater extent with this government, or is it a tactical play by what is now a party that's essentially a kingmaker for French politics?
It is very much a tactical play. So what the National Rally has been trying to do basically since Marine Le Pen came to power is go through this process of respectabilization, where people are going to take them more seriously as a potential governing force. And their calculation is that if they don't vote out the government immediately, this is going to make them look like a responsible political force rather than a simple opposition. And that this is going to basically put them in a much better position later on, when a new election is called, to actually win it.
So you assume, based on your analysis, you assume this government will survive to the point where it can put a budget to the government, to a vote, essentially. The October budget has been delayed already. What are you going to be looking for in that budget?
So my expectation is that they will actually be able to put forward a budget. I think they are going to be trying to put forward a budget that doesn't anger the National Rally too much. Which basically means they won't be putting up taxes, or at least they will try not to put up taxes for what they've called regular citizens, essentially. I think we're going to start seeing many more problems the closer we get to June next year.
OK, so more problems as we get to June. And as you said, it's 12 months, about a year before they can call other elections. How has this left the credibility of Macron domestically and internationally?
Macron's credibility at home is, I would say, probably shattered, in a sense that he called this election with the expectation that he would either win it or that he was at least going to get rid of the left. None of this has really happened for him. What he has ended up with is a hung parliament. He no longer is in control of the government, and he has no way of basically passing through the measures that he would have wanted to pass through. So I think it doesn't really leave him in a good position. And although some people think that this is some genius play and that this is absolutely going to help keep the National Rally out of power in 2027, I am not fully convinced by that analysis.
You're not convinced. We're seeing the spread, again, between French sovereign debt and its German counterparts increase again. So the spread has widened to about 80 basis points. Given what you know about the political machinations right now happening in Paris, in France, are the markets getting this right? Are they underestimating the political volatility and instability to come, or overestimating? How do you think the markets are interpreting this? Are they getting it right at this point?
I would say they're probably getting it about right. We are in a situation where France is going to be fairly unstable, because what you have is a government that depends entirely on the far right to keep going. And the problem with that is that the far right has a great interest in this government falling at a point where it is convenient to them. The problem is that we don't really know when it is convenient to them, and they might not know it yet either. It is going to depend a lot on what other measures does Macron's government, or Barnier's government at this point, try to pass. OK, so we have to follow the National Front, or at least the National Rally, as they've been rebranded, very closely in terms of how we think about when they may pull that card. When it comes to the politics of Germany, we had a reminder, of course, of the challenges there, particularly around the far right, as they would be characterised by some. Chancellor Scholz managed to cling on to these gains in these key states over the weekend.
What do you think? Do you think he remains the head of this SPD? Do you think he can be the candidate for them in the elections next year? Where do you think German politics is heading?
Well, I think German politics we have to be very mindful when we're looking at the success of the AfD in Germany, because we have to keep in mind that this is a party that is very successful in certain parts of Germany, and particularly in what used to be East Germany. Whereas at the national level, they're not still that strong because of a variety of reasons that we can't really get into because we'd need a full day for this. But I think that this is something that is really important to keep in mind, that local elections in Germany or regional elections in Germany don't really tell us much about the national trend. So I think Scholz can probably still stay candidate, but his problems are bigger in the fact that his coalition isn't particularly popular at the national level. OK, really important context in terms of the AfD and how much progress they have made at the state versus the national level. Thank you very much indeed for the context around French politics and Germany as well. Marta, Lorimer, Cardiff University lecturer in politics. Coming up, Intel's turnaround strategy receives a vote of confidence from Apollo, reportedly to the tune of several $1 billion. Intel up pre-market on that story. More on that scoop next. This is Bloomberg. Now, Intel is higher pre-market after Qualcomm approached the chipmaker about a potential takeover. And separately, Bloomberg understands Apollo has offered to make a multi-billion-dollar investment in Intel. Let's bring in Bloomberg Deals reporter Manuel Baigorri then for the details. Manuel, how big a vote of confidence is this then potentially in terms of Intel's turnaround strategy?
Definitely a very big boost for Intel, Tom. Indeed, a big deal. We at Bloomberg had the scoop, and definitely a big vote in confidence in that turnaround plan for Intel, which, as we all know, has been struggling and shedding billions in value in market cap in recent years. So it definitely is a big mark. Apollo, a very well known in the alternative asset management space, which was traditionally more known for distressed debts, but has built itself into more insurance and credit in strategies in recent years. And actually an interesting bet as well, because they both have a partnership that goes for quite some time. So it'll be interesting to see how it plays out, this potential up to $5 billion equity investment into Intel for sure.
Yeah, I think this is fascinating, given, as you say, what it means around and what it tells us around the transformation at Apollo, of course, in terms of private equity and how it's shift focus, but also what it means for the chip sector of the US. And we're getting a sense now that Intel is getting a number of lookers right now. I mean, they're getting a lot of interest despite the challenges around the turnaround. We've got the potential Qualcomm takeover offer. Where does that stand?
Yeah, that is definitely fascinating, Tom. Just over the weekend, news unfolded on Qualcomm's approach for a takeover of Intel. That would be a huge deal if it were to happen, definitely. I mean, the CEO of Intel has been pretty vocal that he believes he can turn around the company. Definitely, it's been a struggling, strategy, but he still believes that he can. Intel can remain as a standalone business, but obviously the industry is consolidating despite all the politics involved and how strategic chip making has become globally. Qualcomm is making a move for its smaller rival. I mean, definitely an interesting potential deal, but also a very complicated one given the sheer size. So a lot of moving parts, and definitely the CEO of Intel has been vocal. He believes in the company as a standalone business, but he's also open to consider alternative options.
OK, Manuel Baigorri, thank you very much indeed, always with the excellent context around the potential deal-making in the offer. Intel with a couple of suitors right now. Bloomberg's deals reporter in Hong Kong. Pre-market Intel is up. Up next, Bloomberg Brief with Danny Berger in London. Manus Cranley standing by in New York. Do not miss that show. Stay with us. This is Bloomberg.